Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
2026 is just around the corner, and markets are shifting in surprising ways, from jobless growth to energy gluts. We look at the trends that could shape the global economy over the coming year.
Will AI bottlenecks slow us down? Will the mad metals rally continue? And can we even trust the data? And in today's dumb question of the week, are we still on track for the roaring 20s? All right, let's get into it. So it's that time of the year where we're still nursing a food hangover, we're a little bit merry, and we must look forward to the year ahead. What trends are going to shape the markets next year, Roman?
So this is going to be a prediction episode, isn't it? And I know what's going to happen. We're going to make some kind of confident forecast, which is absolutely wrong. But still, that's entertainment, isn't it?
No, we'll hedge our bets like we always do. We'll say, if A, then this, if B, then this.
But I think there are some really interesting trends, which we saw at the end of last year. And I expect that they will carry over into next year. And if anything, they may become even more entrenched.
That's a macro strategist view, isn't it? Just extrapolate into the future. But I think with these trends, some of them are really nascent, aren't they? And some of them, are just screaming at us in the face. But anyway, let's start with macro trends, because there's one phrase which I've seen repeated again and again, and I think it's even been raised by central bankers, and that is jobless growth.
So let's just say what that is before we carry on. The idea is that you have an economic expansion, in other words, GDP's powering along, or just ticking along nicely, but at the same time, you're not seeing employment improve. So you're not seeing more people being employed to service that increased demand for goods and services, which seems pretty weird on the face of it.
Usually those two things are pretty strongly correlated, aren't they? It's hard to get an economic expansion without employers hiring more people.
That's especially true in the US, where there's a very easy market in terms of hiring and firing. During the pandemic, there were loads of people laid off, and then as we recovered, loads of people were employed. Whereas in the UK, it was much more smooth. But in the US, that's why the unemployment rate is such a good indicator of recession. In the UK, not so much.
So what's different this time? Is something different?
Well, what people are saying is that AI has effectively allowed companies to increase their productivity without hiring new people. So if you've got an entry-level job which requires research, for example, well, things like Claude, Gemini, things like ChatGPT can certainly fill that role. Maybe not as reliably, maybe more reliably than an intern.
But to look at the hard numbers, US GDP growth is really strong right now. 4.3% in Q3, while at the same time, the monthly job creation stats are not great, are they? They're sort of hovering around 50 to 60,000 per month. So you could make the case that we've got a sort of jobless boom going on.
And this was certainly discussed during the monetary policy meetings, both in the US and in the UK. So, for example, they were talking about how AI infrastructure spending has driven a lot of the GDP growth. And yet at the same time, it's not a very dynamic market. There aren't many people moving jobs, for example. So there's not much hiring and firing. People are tending to stay in the jobs they've got.
Just anecdotally, and I know we shouldn't rely on anecdotes, but I'm a human. What can I do? A couple of my close friends have been laid off in recent months and have said to me that it's explicitly because of AI. And that made me sort of stop and think, because these are good people, really good at their jobs. And I was like, are we really there now? Like, are people going to start losing their jobs?
But it's not unprecedented. For example, if you look at previous tech booms, it was the case that people were laid off before new jobs were created, which then they could fill. For example, if you had the dot-com bubble, well, you needed lots of developers, initially for HTML, and then for all these crazy scripting languages that make the internet work. So initially, people were laid off. There wasn't a huge amount of new job growth, but then eventually there was. So I think you've just got to go through these kind of growing pains when you get one of these technological innovations.
Unemployment in the US has ticked up to 4.6%, even while output is surging. And as you said, I think a lot of that GDP growth is coming from infrastructure spend, that AI data center boom, rather than consumer spending. And a lot of people fear that we could be seeing a K-shaped recovery. Now, that's another kind of buzzword at the moment, the K-shaped recovery. But the idea is half of the population does well and surges up, and half does less well and sees their real incomes shrink. And I guess that could play out in interesting ways with consumer spending, which traditionally has been such an important driver of US growth.
And it's a pity because what we were seeing leading up to the pandemic was that lower income households, certainly in the United States, were doing better. They were seeing better wage growth, and that was kind of decreasing the gap between rich and poor. And yet after the pandemic, what we've seen is a widening of that difference between the richest and the poorest.
I wonder if this is going to be like previous episodes where we've seen outsourcing, like where a lot of jobs moved to cheaper parts of the world, and then companies realize it hasn't quite worked and they've pulled them back again. A cynic about AI would say that might be what we see this time. Chief technology officers get overexcited about vibe coding or whatever, lay a load of people off and then go, oh no, my app's broken. But we just don't know yet, do we? It's too early.
No, I think that's true. But I see it in my own family. If I look at my family tree, I had bridle bit filers, who were people who made bridle bits. When there are lots of horses around, well, that's great. But then my family had to retool and they became draymen. So they were the guys who got on the horse and kind of pulled the beer around the country. So they had to, I wouldn't call it upskill, it's just
Right.
different skill. It allowed them to also pursue heavy drinking in another role, which was very handy for my family.
When ChatGPT can bring me my beer, the world will be solved by that point. But anyway, how likely do you think this is? I know we said we're not going to make predictions, but jobless growth, real thing? Going to continue?
I think it will. And I think it is a real thing. And I see it already. We see it in pension craft, where we would have hired a junior to maybe do some of the research for us. We just don't need it anymore. But like you say, I think some things just need to be checked. And if you've got a mission critical app, you're not going to have Claude or Gemini writing the code itself. You're going to have some really experienced, hairy-arsed old developer who knows his beans. That's who's going to really look over the code and make sure that it keeps going.
If we do see jobless growth lasting for a long time and a K-shaped recovery, this kind of decoupling between the labour market and economic growth, then I think that's going to make the political situation even more tense than it already is. Already at the moment, there's a definite disconnect between what the public says about the economy, especially in America, and what the stats actually show. People aren't feeling a boom right now.
And if the boom is coming from increased spending on infrastructure, well, there will be certain jobs which are going to benefit. And again, it's this idea that when there's a big technological upheaval, there are certain very targeted parts of the economy which benefit directly straight away. And then the ripple effects spread out into the broader economy. And I expect that's what we'll see this time around as well. There will be growing pains, there will be job losses, but then new roles will become available which weren't even thought of before. But that's not good for politicians because people are not patient. They're not willing to say, well, I know I've lost my job, but eventually things are going to get better. That's not what they're willing to see. So I'd expect, like you suggest, that there's going to be political change that goes hand in hand with the economic change that we're seeing.
And in terms of an investment thesis off the back of this, the first one that comes to mind is, do you believe the AI hype or not? Should you be in the Mag 7 or not, obviously? But is there a kind of more subtle theme going on here? How could you play this?
Well, one way is indirectly. So you could look at the AI infrastructure plays. For example, it could be energy infrastructure, it could be cloud services, it could be fast memory chips, although a lot of that has already rallied. So I think that ship has pretty much sailed. Another one would be to do with the K-shaped recovery. If it is the case that the poorer parts of society are going to underperform the more wealthy parts, then you'd probably support things like luxury goods versus consumer staples.
I wonder if it's the middle that gets hollowed out, as in, if the rich are still fine, then the real luxury goods will do okay. And consumer staples should do okay because people have still got to eat. But that mid-market stuff, which is kind of targeting people with a little bit of discretionary spending, ways people treat themselves, maybe that would suffer.
Yeah, so maybe something like consumer discretionary versus luxury would be a better way to play it.
You mentioned something interesting in passing there, which I think we should drill into a bit more because it is a trend we're seeing, which is around AI and what the bottleneck is. The bottleneck up to now has clearly been chips, Nvidia has been so profitable just because it's selling chips faster than it can make them. But a lot of people are saying that bottleneck is going to change. It might not be chips anymore. It's going to be the infrastructure that underpins it all, like the electricity grid.
And it's such a boring thing. I mean, you try and read about energy infrastructure, which I have done, right? Because I thought it would be relevant to what's going on this year. An interesting factoid that I dug up was that transmission lines take much longer to get permits for than power plants, usually about twice as long.
Is that because no one likes pylons?
That's right. Laura's actually terrified of them. She's got a phobia of power lines.
I guess you use that in the planning complaint, don't you? It's a legitimate medical condition. I cannot look at power lines.
But it's a real constraint. And I think that might be really what does for some of the rate of expansion in the United States, at least. And I've already seen pushback in the UK, people complaining about data centres being built, because of course a lot of it is being built around London, where there's this real competition to get houses built. And there's also competition for green space.
I believe there's some parts of London, West London, I think, where you literally can't build houses because they can't supply the energy. The grid's at capacity and it takes so long to build out more capacity.
And you've got to get rid of the heat, which sounds like a boring problem, but it's a real problem because you have to use water usually to do the cooling. And that has a big demand in terms of, pumping water, maybe out of a ground source, maybe from a stream, maybe from the sea. I don't know whether they'll do that.
Salty chips.
All very good.
But in terms of the energy side of things, in the US, we have seen electricity prices really rise quite sharply, especially around data centers. And I know that some data centers are having to bring in sort of gas generators, like drive them in to run the data centers because they can't rely on the grid.
But to put some numbers onto this, the expectations, and there's a report by Deloitte which talks about this, the expectation is that AI data centers are going to consume about 90 or more terawatt hours, and that's by 2026. Now, it was already the case that in 2024, about 1.5% of global electricity demand came from data centers. But now the demand is really going vertical. So it's a question of how we're going to deal with that.
Well, in the short term, they're switching back on or planning to some of these nuclear reactors, aren't they? And you know that companies like Microsoft and Alphabet are doing direct deals to secure this power supply. And inevitably, they're talking about long term, we're going to put the data centers in space, powered by solar. Sounds like science fiction.
Yeah, I don't see that happening in a hurry, but I just don't think it's very practical.
How do you get the data back down to Earth?
What if something goes wrong? You'd have to kind of go up there and fix it. I mean, it's not very practical, I don't think. But you're right. I think companies like Nvidia, OpenAI, they're planning huge amounts of new energy capacity built into these data centers.
Presumably, if we're staying on Earth, though, the data centers should move to where the electricity is cheapest. But then I guess there are privacy concerns and national security concerns if you don't control these things on your home soil.
Yeah, I mean, do you really want your data center to be based in Dubai?
Do you want it based in America? I don't know. I mean, it sounds like a joke, but I think it's something Europe takes seriously now. They want sovereign AI capacity.
Yeah, I think the assumption that the US is going to be an ally forever may not be as unquestioned as it was in the past. Now, there are a couple of ways of investing in this. A lot of them have already rallied. So we talked about the energy infrastructure, companies in the US like Dominion Energy, for example. You could go for power equipment, so gas turbine manufacturers, for example, or grid equipment manufacturers. Or you could go for data center REITs, which are real estate investment trusts that fund this kind of infrastructure for data centers.
Or you could go for copper directly, which we might talk about a little bit later on.
Yeah, I'm all for that one.
But I want to take us on to the next potential trend, which is around bond yield. Sorry to keep it on the boring side of things, but we've got to talk about it. So everyone's expecting monetary policy to keep gradually easing over the next year. I think the market's pricing in another 1 or 2 rate cuts from the Fed. But even while that's happening, that doesn't necessarily mean bond yields will fall, particularly when you get out to durations like 10 years plus. So I wonder if there's a trend here where the yield curve is going to keep steepening.
Yeah, I think people often get confused by this because they say rates are being cut by the central banks, so bond yields should fall. And what they're assuming there is that if you cut short-term rates, well, long-term rates will fall as well. Well, that's not always true, and that's what we mean by steepening. The long end either stays high or increases in yield, while the short-term rates are falling. And there are reasons why that should happen. If there's simply very little demand for those long-term bonds, well, that pushes down the prices and it pushes up the yield. And that tends to be what we're seeing for various structural reasons. Lots of the typical buyers of that long-term debt are kind of pulling back from the market because of demographics or because of winding down of DB pensions, for example, in the UK.
Plus, there's like genuine concerns about the level of sovereign debt. A lot of countries have debt more than 100% of GDP. Plus fears that inflation could surge again. All of that has to get priced into the long end of the curve.
And that would tend to push you away from buying those long-term bonds, yeah. So I think there are various reasons why you could get a yield curve steepening going into 2026 in developed markets.
Not least the fact that all this capital investment that's going on in AI and other infrastructure is long-term in duration itself, if you think about it that way, and is competing for capital with long-term bonds, really. If there's an investment boom, that's going to push up yields at the long end of the curve as well.
Now, you're probably thinking, oh, Roman, just rabbiting on about bonds again. I don't care. Well, the reason why you should care is because the 10-year part of the yield curve is the bit which pretty much drives what happens in the housing market. Also, if you're going to buy an annuity, well, those bond yields suddenly matter a lot. So you should be hoping for higher bond yields before you buy your annuity. So this really affects people. And that's why I think it's important that people understand what the drivers are and where rates may be headed.
If you had to buy bonds right now, which part of the yield curve would you go for?
I'd buy part of the yield curve where I could hold to maturity, i.e. my lifespan is going to pretty much determine the maturity of the bonds. So that's why I think, I'd keep it fairly short term.
Oh, that's a good way to start 2026, isn't it? But let's take the hold to maturity thing off the table, right? You're managing a bond fund. It's going to last forever, we hope. What part of the yield curve are you buying?
If I'm buying it for a hedge, for equity, I'd probably go for the middle part of the curve because I wouldn't want to take too much duration risk. I'm still a bit worried about what's going to happen to yields, and I'm still a bit uncertain about which way it could go. But I'd go for the belly of the curve because that's the bit that would rally most. And I think there's a bit more juice now that yields are higher, and that would give it the capacity to rally if there is a worry about the equity market.
I think I'd be pretty nervous about holding much duration at the time that Trump announces the replacement for Powell. Because if that is a really political appointment and it looks like they're going to hold rates artificially low, even if inflation picks up, yeah, the bond market might not like that. I'm not saying that's the way it'll unfold, but I'd just be nervous about holding too much duration at that time.
What seems to have happened, though, is that markets have just got used to Trump saying all this crazy stuff and all the crazy policies. And it seems as if that worry doesn't seem to be affecting markets anymore. But of course, all these things are always not a worry until they are.
I think it's Scott Bessent that's sort of keeping everyone in check. If Trump and Bessent fell out and Bessent got fired, I think you'd see a pretty strong reaction, wouldn't you?
Yeah, I think so. I think he is holding back some of the craziest stuff and making it very clear that the bond markets matter and informing the policy discussions in the White House.
So the bond markets matter and they rely on good quality data, right? A potential trend we're seeing, just the seeds of, I guess you would say, is a question mark over whether we can trust the official US economic data anymore.
And there are two reasons for that. One of them, which is pretty much a boring one, which is that less people are responding to surveys. Another more worrying one is that it's to do with political pressure and how that's affecting the economic numbers which could be published. The thing to remember is that after the Great Depression, the US statistical system was set up specifically to avoid political interference, which had affected the numbers during the Great Depression. And that's pretty much been in place, that system of checks, since the Second World War. And it's only now that people are starting to question those numbers again.
Obviously, Trump fired the head of the Bureau for Labor Statistics because he didn't like the numbers. Then there was a big gap because of the government shutdown where we just didn't have the numbers. And then we had this deluge of data where the growth figures were really strong and significantly above expectations. You can see why people might be skeptical.
Plus, at the same time, a lot of the advisory panels have been disbanded, and that happened in March of 2025. Now, you do want some kind of oversight in how the numbers are calculated, and disbanding those oversight committees, I think, is not a good thing to do.
What would the consequences be if it became widely accepted that the US numbers aren't as reliable as they once were, even if they're not, explicitly just cooking the books to a ridiculous degree?
I think from the point of view of equity markets, any kind of uncertainty is going to reduce equity valuations in the US, because I think a lot of people rely on the US as being a really safe place to invest because they can trust the data. You look at the governance, it's good. It's not like investing in emerging markets where you can't trust the governance or trust the economic data often. So I think that would erode US valuations, certainly from the point of view of foreign investors investing in the US.
It presumably wouldn't be good for the treasury market. I'd expect investors to demand a higher risk premium if you can't trust the data, right?
And it's worthwhile mentioning how you could track for these errors or deliberate manipulations. There are private data sources. So, for example, for the jobs market, you've got ADP payrolls. There are private inflation trackers. You could use those and compare them with the official data and just see if there is a discrepancy. I mean, usually it was the other way around, right? You'd look at the private numbers and compare it with the public ones, but maybe people start doing it the other way around.
If it goes down that route, though, where everyone has their own numbers effectively, surely that's going to introduce more volatility, because how can the market price efficiently if no one's looking at the same data?
Yeah, I think that's definitely a source of risk premium, but I think that's a long way off. I think we're still a long way from that, and I expect we're not going to get there. I think Trump's term will end before anything like that happens.
I think we'll get there in 2026. There we go.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, one of the big trends I'm seeing flagged for next year is the potential for an oil glut. And we know how important oil is for the global economy.
Yeah, it's still a good proxy for growth. If you see oil prices increasing, it's often because there's a big demand for oil because there's greater economic activity. And if you see the opposite, oil prices falling, well, that suggests that markets are kind of pricing in a weaker period of economic growth.
But we are seeing oil prices weaken. They've fallen below $60 a barrel. They could fall further. So just like we might be seeing jobless growth, the economy expanding without new hiring, could we see oilless growth?
I think we're still a long way off that. I think that what we're seeing is actually a shift to different demands in terms of energy. We mentioned the infrastructure for AI. A lot of that is now being built on renewable energy. But it's still the case, I think, that we'll have this huge tail of legacy demand for things like oil, gas, and that's going to carry on for decades. I had someone round to service our boiler, and he was really cynical about energy pumps, energy heat pumps being used instead of things like gas boilers in the UK. So I think there will be that huge momentum about people replacing one with the other.
Any incentives at work there? The boiler repairman thinks boilers are going to be needed forever. I don't know.
Well, interestingly, he was quite forward-looking. He said, yeah, I've actually trained to fit both of them, but I'm not seeing much demand for air source heat pumps, at least not yet.
Yeah, us Brits are slow to adapt. We'll install these heat pumps over our cold, dead bodies. Right? But let's go back to oil. So I want to talk about oil. It seems like a big trend. So Brent crude was like $80 a barrel in early 2025. It's fallen significantly since then. What's going on here? Because economic growth looks reasonable.
Well, I think organizations like OPEC are less powerful than they used to be. Often they'd be the ones who would reduce supply when there was a fall in the price in order to keep the price higher. That doesn't seem to be the case anymore. I think they tend to be more fractious, there's less consensus, and that's made it difficult to drive policy in terms of supply.
And there has been a big pickup in non-OPEC oil supply. That's where the growth has come from.
Yeah, US shale is the big story there. So the US has gone from being heavily dependent on oil imports in the 70s, which caused a sequence of crises, to a country which is now almost an oil exporter. I think it is now an oil exporter.
So one of the consequences of that is that forecasters tend to think that in 2026, supply will outstrip demand in the oil market and the price will be stagnant or maybe fall further. But obviously we know the oil market is volatile. That could all be blown up by a war in the Middle East or sanctions on a country or whatever. But if it were to play out, if we've got this glut and the oil price is weak, what would that mean for economies and markets around the world?
Well, certainly for countries like the UK, that's not a bad thing because it's a big cost to UK companies, energy, and a large amount of the energy that we produce is generated by fossil fuels, which we import. That's also true of countries like Italy, India. So those countries will probably benefit from this. Clearly for energy producing countries, such as those in the Middle East, maybe even Canada, those energy prices are going to be a problem. But I would also say that if you're planning to pile in and buy some energy tracking fund, well, be careful because there's often quite a lag between these periods of glut and the periods where there's a supply crunch. Usually that lag is 2 to 4 years. So, for example, we saw a glut in 98, and then in 2002 is when we saw prices surge. Then in 2015 and 2018, the same kind of pattern. So it may not happen quickly. You have to be patient.
But if we stay with commodities for a while, some parts of the sector have the opposite problem. So if we look at metals, both precious metals and industrial metals, they've been rallying like crazy in recent months.
Yeah, the shocking one in 2025 has been silver and then followed by gold. So it looks like silver's going to end the year somewhere between 150, 170% higher than it started the year. And for gold, it's up about 73% year to date. So an utterly astonishing year for precious metals. And the reasons behind that are very well trodden. For example, we've had a lot of central bank buying. So for example, China, Turkey, Russia, India, they all built up their gold reserves through the course of 2025. China in particular had 13 consecutive months of buying. So clearly they're getting ready for something.
Meanwhile, its holding of US treasuries has fallen to multi-decade lows. They're shifting their national balance sheet, aren't they?
Yeah, I wonder why.
Nothing to laugh about, Roman. That would be terrible if that happens.
Yeah, I know. We would pretend that's not going to happen. So another thing, obviously, geopolitical risk. That worries people. When people are worried, they buy gold. And of course, we've had a rate cutting cycle except for Japan. And that tends to push up the price of gold because it's a wasting asset. If you've got treasuries with high yields, then they pay you an income, and that makes gold less attractive. But if treasury yields are falling, then that makes gold more attractive.
And let's look at silver, because that's a bit of a weird one. It's a precious metal, so benefits from some of the same drivers as gold. But it also has genuine industrial demand and is needed in some parts of the green transition. And it had a mean reversion effect, I think. So it had a long period of relative underperformance compared to gold. and now has sort of snapped back to where you expect, in quotation marks, silver to be.
Yeah, and that's to do with the way it's produced. I did a video about silver recently, and so I had to learn how it's produced. And it's often a byproduct of things like lead mines, zinc mines, copper mines, gold mines. And that means that if there's an increase in demand, you can't increase the supply to match because it's just a byproduct. And that means it tends to react more extremely, if you like, a higher beta than gold itself. So if gold surges, then silver surges more. If gold crashes, silver crashes more.
So we've got gold, silver, and I want to do bronze, but it's not bronze, is it? It's copper is the third one we need to talk about.
Now, this is one close to my own heart because I've got a copper miners portfolio, which I've been running for, 1.5 years now, and it's finally paying off. So I'm very happy about this rally.
But copper is very different to gold and silver. Copper's not a precious metal. It's precious for your portfolio, but not in the sort of global stakes.
But that's an interesting one because if you look at the amount of copper needed per unit of GDP, that's increased over time. And that's because of the energy transition. If you look at the amount of copper that's needed to pipe in energy from an offshore wind farm, that's huge. And if you look at EVs, electric vehicles, compared to internal combustion engine cars, they've got lots more copper inside them.
People have seen the copper rally coming for a long time, right? You being one of those people. It's weird, isn't it, how long it takes markets to price these things in?
Yeah, I've got to say, I almost lost patience with it, but I didn't. I kind of stuck with it. Because the good thing is I went for the miners where I'm getting paid a fairly good dividend while I wait for the market to agree with me.
But will it keep agreeing with you? Let's look at gold, silver and copper together. They've all rallied strongly. But this is not about last year. This episode's about 2026. Is it going to continue?
Well, if you ask the precious metals desks at any of the banks, of course they say yes, because a gold strategist is not going to say that their precious metal is going to be in the doldrums for the next decade. But it is ridiculously overpriced as much as you can price gold. And we do have a simple model for our PensionCraft members, and that's showing that currently it's hideously overpriced, particularly silver. So gold's overpriced by about 40% according to our very simple model, and silver by a massive 88% currently.
You've just been fired from your job on the metals desk for stating that fact. But it's not a fact though, is it? These are models built on historical norms. Maybe there is a genuine structural shift happening here, which means that those norms don't apply anymore.
That's possible. It's certainly possible. But personally, my money would be on that not being the case. And I wouldn't be piling into precious metals right now as a result of that. So I'd expect that there is going to be something of a correction in gold and silver over the course of 2026 because numbers have just got completely off the scale.
What are the risks? If it's a metals bubble, what could pop it?
I think that central bank buying isn't going to go on forever. There's going to be a certain point at which they've got enough reserves and then the buying will stop. And I think we're already getting to that point. Or it could be that we see policy rates being hiked very rapidly because of an inflation shock. And that could come from various quarters. It could be an energy shock. It could be a supply chain issue, as we saw in 2020. There are lots of reasons why you could get an inflation spike.
Do you think silver and copper particularly are quite tied to the AI investment bubble, if you want to use that word, certainly boom? And if that slows down for any reason, these metals will suffer.
I think copper is obviously tied to the boom in AI because of the infrastructure and the energy demands. Gold and silver, I think, are driven by different factors. And I'm slightly worried that this time around, it may not be the case that if there is a big shock, that gold would act as a safe haven because of the price it's already at. And that would worry me because I think a lot of people are making that assumption. And this time might be different, certainly when it comes to gold and silver.
You mentioned the possibility of an unexpected rate hike there. I think that's worth digging into as a potential trend, just monetary policy generally. So we've seen rates coming down gradually across almost all the world, Japan, one exception. But there's an assumption that that trend will continue, at least in the US and the UK. Maybe Europe is pretty much done now. But what if we get a surprise? it's not impossible that we get an unexpected rate hike. And that would really put the cat amongst the pigeons, wouldn't it?
Yeah, I'd say the US is most at risk from that, because if it is the case that we get a new Fed governor who's going to be cutting rates regardless of what happens with inflation, well, guess what's going to happen? I don't think it takes a genius to realise that could be the source of an inflationary spike. Plus, so far, the tariffs haven't been inflationary. It hasn't been sticky, I should say. There has been some signs of goods inflation, but it looks like that's just a one-off. You're always comparing on a 12-month window. And if it does turn out that it is sticky, well, that would be a problem. But I wouldn't rule out something like a supply chain issue over the course of 2026 if there is something like a geopolitical escalation of the war in Ukraine. Then we could see supply chains being severely disrupted. If you were a foreign power that wanted to really hurt the West, well, we've seen how fragile those supply chains are. So now it's pretty clear how to disrupt them militarily. So those are the kind of really extreme cases. The central case, though, is that, no, we're going to see inflation carry on decreasing and we're not going to see a big spike. So we will see central banks carry on cutting.
Now, just one last point, one last trend before we finish. And we've mentioned boring a few times. This combines a lot of boring things. It combines bonds, it combines pensions, and it combines the Dutch. So this is the Dutch pension reforms. I actually love the Dutch, don't worry. But this is the Dutch pension reforms, which apparently could have a big impact, potentially, on the European bond market.
Now, you might be thinking, why would Dutch pensions matter? The weird thing is, if you look at the size of pension funds globally, the Dutch pension system is absolutely huge compared to the size of the country.
Certainly in Europe, because the Dutch pension system is funded. They actually have assets, whereas a lot of European countries are just planning to pay pensioners out of future tax receipts.
And if you look for the people who are buying duration, as a strategist would say, that just means long-term bonds. The Dutch have been really punching above their weight there too for the last 2 decades. So if these people pull out, then that could push yields higher quite sharply.
Why would they pull out? Well, what seems to be happening, I'm not an expert, but what seems to be happening is they're moving from effectively a defined benefit pension scheme to a defined contribution scheme in stages over the next few years, and it's just about to start. The worry, presumably, is that if the Dutch aren't going to buy these long-term bonds in Europe, who is?
And remember, at the same time, what we're seeing in Japan is yields rising. So that's another source of selling of developed market bonds, excluding Japan, of course, if people are repatriating money home.
At the same time, as countries in Europe like Germany are planning to issue quite a lot more debt to fund defence spending. Is this the perfect storm? Or is this being blown out of all proportion, Roman?
Well, it makes for a good story. And if we get it right, that would be great for our listenership.
What does get it right here mean? Does it mean sort of long-term yields in Europe rise by a percentage point? What is getting it right here?
Well, yeah, I mean, what we saw in 2022, 2023, that big bond sell-off, many people expect that was a once-in-a-generation shift. But if we see yields jump up another percentage point from where we are today, that would be very shocking, I think.
I kind of think that Europe could do with a bit of a yield curve steepening, though.
Well, I guess it would be nice to have a bit more yield at the long end, but not if you've already bought bonds. This is the weird thing. If you buy bonds and then yields increase, not so good. But if they increase before you buy, well, happy days.
Yeah, I guess we want them to increase for good reasons, which is that Europe's growing again. So yields go up, not because of a technical shift in how Dutch pension funds are structured.
Yeah, or some weird macro effect. But that's usually the way things happen, unfortunately.
I think this is a trend that comes with the caveat, beware, it's crowded. It's a crowded trade. People are well aware of this. All the bond strategists in Europe are talking about this. So you're definitely not early here.
But I think the surprise for me would be if things were actually okay in 2026, because a lot of people are saying that there's going to be a popping of the bubble, that we're going to see huge geopolitical risks start to be realized. But what would the surprising thing be? Well, if things just grind along as they were, which wouldn't surprise me at all. So I think there's always a tendency to think that, you're being clever if you see these trends happen before they happen. But I wouldn't get too depressed about 2026.
Sticking to the plan in 2025 worked out just fine.
Now, if you are worried about 2026, but more worried about how to invest, then why not join our community of like-minded investors with a long-term mindset where you can discuss this with other people. If you want to learn more, just go to pensioncraft.com/membership.
Okay, today's dumb question of the week. Are we still on track for the roaring 20s? Now, I thought today's a good time to tackle this as we're halfway through the decade. And do you remember all those calls, Roman, that this decade is going to be exceptional, reminiscent of the one 100 years ago, where technological innovation leads us to a productivity boom, strong real growth, great corporate earnings, good wage growth, and all in all, happy times. Let's not talk about what happened after the 1920s. But anyway, are we in the roaring 20s right now?
Well, it has been pretty good. Certainly for investors, it's been pretty good so far. Since 2020, we have had a couple of rough patches. We had the huge pandemic sell-off, but equity markets recovered very quickly from that. Then we had the wobble in 2025 with the Liberation Day tariffs, but again, markets recovered very quickly from that. What I think we haven't seen is a big, old-fashioned, long period when equity markets have a lull. Overall, investors who just bought a global index fund and stuck with it have done very well indeed.
That's all true. But I think for it to truly be a roaring 20s, what we'd need to see is like genuine delivery on productivity growth. It's all well and good building these data centers, developing these AI models, and they are incredible. To me, it's staggering how quickly we've got used to them. This would have seemed like magic just 5 years ago. We're living with magic and we're like, just keeps getting stuff wrong. Anyway, it's pretty good. But is it going to lead to greater output per hour, productivity growth, sustainably?
I think for things like the knowledge economy, I think it probably will. I already feel it. For companies which are service-based, again, where you're not shuffling material around, you're shuffling ideas around. Well, for that, it's great. Now, that indirectly, I think, actually is also a bull case for the UK, which is a service economy. So if we use AI very effectively and train to do that very quickly, I think this could be a golden age for the UK.
Depends if the profits are captured by the underlying tech stack, i.e. the owners of the models, the owners of the chips, which isn't us in the UK, or is it going to be captured by existing industries adapting their business model and boosting their margins? We don't know yet. Be some split between it.
Well, hopefully there's going to be competition amongst different countries in providing these AI services. And we did see DeepSeek disrupt the US briefly, coming up with what seemed to be a more efficient model. And I think if there was competition from China, it could push down the price that is going to be charged for those services for AI from the United States. It's not going to have the monopoly on that technology.
From a UK point of view, we're so reliant on exporting services, right? We're trusted in law and finance and all those professional services. That what really matters is whether this AI age is going to disrupt the existing players, so you no longer have to hand over loads of money to a UK law firm. You just ask the chatbot, which is based in America or wherever, or whether people are still going to shop in London for those services and we're just going to keep more of the money because it's cheaper to provide them. We don't really know about that. But to go back to the Roaring Twenties thesis, one of the big proponents of it was Ed Yardeni, and he'd been long the Magnificent Seven for a long time, like 15 years or so, and has always been saying this is going to be an amazing decade and it's going to be driven by US tech. So far, he's been right. But interestingly, earlier this month, he suddenly went underweight the Magnificent Seven. He switched his thesis. I don't think he's calling that the decade's over and the Roaring Twenties is over. He's just, I think, saying, even for him, the Magnificent Seven look a little bit stretched right now. And he actually says, in effect, our spin is that every company is evolving into a technology company. And in that world, I guess, why would you just pick the tech companies?
And this is what you'd expect. You'd expect that as adoption of AI increases, it's going to affect every single type of company, even ones which on the face of it aren't tech companies.
So Mr. Yardeni is going overweight financials, industrials, and healthcare at the moment. That's his pick.
But like we said earlier, if you've got the bridle bit filers, they've got to retrain to use this new technology so that they can pull beer around the country, or the equivalent for AI, which would be to apply a lot of the AI technology for the typical services that we provide, whether that's legal, whether it's IT, whether it's management consultancy. All of these, I think, would benefit from the really targeted use of AI. But we're just going to have to be quick on our feet to pick it up and use it effectively and cost effectively in order to do that.
I think that's the key for me to whether this is or isn't a new Roaring Twenties, is that if it's just focused on a narrow handful of tech companies, then it's not. What we would need to see is a genuine economy-wide lifting of all boats. That's what the roar is, not just a load of cheering in Silicon Valley. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.